Access your money the smart way, not the dumb way. In this episode, I'm going to answer the question, what is the best way to get money out of an IUL policy? That's an indexed universal life policy. This is very powerful. I don't want you to miss out. Stay with me through the end of this episode. You're going to be blown away. So I'm Doug Andrew, and I started in the financial services industry clear back in 1974. In 1980, when EF Hutton first introduced universal life, they were sort of the brainchild behind using universal life as a concept to buy term and invest the difference on steroids because it's under a tax-free umbrella. When EF Hutton came up with the idea, some people used universal life as a cheaper life insurance policy than whole life because on one end of the spectrum, because of high interest rates back then, you could pay a lower premium into a universal life policy than a whole life policy for the same death benefit. But EF Hutton really designed it originally to be maximum funded. This is where you put in the most premium the IRS allows and try to get away with the least amount of insurance the IRS will let you get away with. And those are under tax citations, TEFRA, DEFRA, and TAMRA, which I explain in other episodes. So when you max fund an IUL policy and you do it as fast as the IRS allows, that is usually done within 3 years and 1 day, maybe 4 years and 1 day if you're older. So if you wanted to reposition, let's say $500,000, it could be $100,000, it could be $1 million, but usually the fastest you can fund that would be in 5 payments or installments, basically. You could do it monthly, but 5 years. But you can actually fund it the first day of the first year. And so you do that for 4 years, and 1 day into the 5th year, you could actually put in the last amount. So let's just keep it simple. Let's say you wanted to reposition $500,000 into an IUL policy to generate and create more liquidity, safety, and rate of return. Did you hear that liquidity was number one? So people always say, well, how liquid is it and what's the smartest way if I need money? Well, in related episodes, I talk about when you have an emergency or a business opportunity, or if you're a real estate investor, many of my clients use an IUL policy as a working capital account to be able to access money faster, smarter, quicker, better than some bank or credit union that pays you next to nothing just because it has a drive-up window. They think that means liquid. No, that's convenience. I can actually access money out of an IUL policy without ever getting in my car. I can do it in a matter of 15 minutes by online filling out one form. It even doesn't take that long. So I'm going to explain this to you and show you how powerful a max-funded IUL policy is to access money. And I don't care if it's the first year when you're only 20% funded, after it's fully funded, or after it's grown to $1 million, doubled to $2 million, doubled to $4 million, doubled to $8 million. Anytime you can access money, but you want to do it the smart way. So I've been very blessed in my career to have authored 12 books thus far, and many of them address insurance and especially IUL, Indexed Universal Life. Indexed Universal Life came out in 1997. So if you are going to be max funding an IUL policy and it's totally full of the cash you wanted to reposition within 5 years or whatever point in time, you can access money if you need it. And so I usually say in my books, well, there's 3 ways to access money. The sad way, the dumb way, and the smart way. The sad way is by dying. Now, it's one heck of a return, but I don't recommend it. But see, if I put in the first 10,000 or 100,000, and if I were 60 years old, the minimum death benefit under TEFRA and DEFRA tax citations would be $1,250,000. If I were a 22-year-old athletic marathon running female, to be able to put in, let's say, 100,000 a year, the death benefit might be $5 million. It doesn't matter. But if I die anytime, the insurance company is obligated contractually, they must pay out that death benefit. and it's tax-free. It's one heck of a return, but it's the sad way to access it. But I have had clients who have died unexpectedly, and it was actually a blessing to their spouse, their children, to whoever they left it to as beneficiaries. Now, the dumb way is by withdrawing the money. And a lot of people go, really? Well, yeah, let's say your money has grown to $1 million, and we'll use that number because it's a nice big round number. It doesn't matter if you have 10,000, 50,000, 100,000, 10 million. So if I have $1 million in there, and if I go and withdraw money, probably, well, you could withdraw all of it, but then the policy would lapse. You want to leave enough in there so that the policy cost of insurance is covered by the interest on the money that's remaining. But if I go access 90%, which usually you can access at least 90% of your money, 900,000, now there's 100,000 left in there. And that is going to hopefully keep the cost of insurance covered for the foreseeable future, the next few years or whatever. But if you withdraw it, that limits how much you can put back, okay? And the IRS says, well, you can only withdraw up to your basis. So let's say you put in $500,000 into that policy, and that's it. That's what you've paid in premiums. That's your basis. And now it's grown to $1 million. If you pull out $900,000, the first $500,000 is tax-free because it's FIFO instead of LIFO, first in, first out. You get the first $500,000 back without paying tax because you already paid tax on that. Whereas so many investments like IRAs or 401ks, it's taxable when you pull it out. It's like LIFO. The last money you're earning is the first money coming out. That's like an annuity. If you put in $500,000 into an annuity and you were earning, let's say, 10%, most annuities don't pay that high, but that would be 50 grand a year. You'd have to pay tax on that because the last money you're earning, your interest, is the first money coming out. That's called LIFO, last in, first out. See, insurance is taxed FIFO. So the first money you put in is the first money coming out. But in this example I just used, you would have to pay tax on anything over and above your basis. That's not smart. You don't have to do that. In fact, the IRS goes, why are you doing that? You're triggering unnecessary tax. Now, they may not tell you that, but in the Internal Revenue Code, they say you do not have to do it that way. You can do it the smart way. Now, if this is already intriguing you, and you can think of somebody who ought to watch this episode, be sure and share it. Click like, post a comment. But stay with me. You're going to be blown away with what I'm going to teach you next. But subscribe to the channel. I post an in-depth answer to a financial question almost on a daily basis. So when you subscribe, click that little bell. You'll be notified every time I post a new episode. But stay with me to the end. I want to gift you a copy of my most recent 300-page best-selling book. Most of my students, my clients, they access it the smart way. That is by borrowing. Now, some people go, borrow? Why would you borrow your own money? Now, hold on. See, when you borrow money out, that is cut and dried, not taxable income. There's only 3 types of income Americans pay income tax on in the Internal Revenue Code since 1986 tax reform: earned income, passive income, and portfolio income. When you borrow money from anywhere, you don't have to report that as income on your tax return, okay? So you borrow it out. So let's say you have $1 million and you want to pull out 10% a year, which many of my clients, they actually get 10% payouts without depleting principal by using the smartest way to access money. Usually there's 2 choices when you borrow money out of an insurance policy. One is sometimes referred to as a zero cost or low cost loan, wash loan, and the other is an indexed loan. Sometimes it's called a variable loan or what have you. Now, the zero cost or low cost loan simply means this: in order for it to be construed as a true loan, therefore tax free, the insurance company is required to charge you an interest rate like anybody that would loan you money, but it can be a very low interest rate. So the insurance company can charge you, let's say, 2% interest, but they are allowed to charge you 2% on what you borrowed. So if you borrow out $100,000 a year, and that goes to 200, 300, 400,000 they're charging you 2% on that loan balance. Now, I call it like a phantom loan. It's not due and payable during your lifetime. It's washed away with the death benefit when you die. But you're accumulating 2% interest on the loan balance. But what's happening to the money that is collateralizing the loan? Because if you went to a bank and you had $1 million sitting in the bank and you said, I don't want to withdraw my $1 million, but could you loan me $1 million because I have $1 million sitting in your bank? Yeah, they'll do that. The problem with the bank is they're probably only paying you 1% interest and they're going to charge you 4 or 5. With the insurance company, it's actually different, because if you choose the zero or low cost loan, they're charging you 2% on the loan balance, but they're crediting you the same 2% usually on all of that money that stayed in the policy as collateral. So they charge you 2, they credit you 2 on this as it's compounding, and it's a zero cost loan. It costs you nothing to get a tax-free distribution out of your policy, one time, annually, or whatever. I've had clients do this for years. And I'll show you why this is a benefit that if you withdrew the money, you would not have. Let's jump to the index loan. So with an index loan, you're borrowing usually at a higher interest rate. And so you might borrow that money, $100,000 a year, or sometimes I've had clients borrow $500,000, $1 million, and they say, you can charge me 5%. But then the insurance company is crediting the $1 million of cash that you did not withdraw. It collateralized the $1 million loan. They're crediting you whatever the index is earning year by year. So in 2017, I had a client that borrowed $1 million. They charged him 5% or $50,000, but he earned 25%, $250,000. $250,000 of growth on that $1 million minus the $50,000 of cost, because he borrowed $1 million. He netted 20% or $200,000 by using the smart way. That happened again in 2021. We had people borrow at 5% and they earned 32 and even 61.33% on their cash while they were using it for something else. This will blow you away. But let me give you one last little insight that a lot of insurance agents don't understand. Let's say you do what a lot of my clients have done. You have $1 million in your policy and you want to start taking out $100,000 a year. Now, you do it under the loan provision, index loans. So they're charging you. Now, you don't have to keep it that way. Every year you can change from zero cost to indexed or whatever based on whatever the market's doing. But if you're borrowing out the money, okay, $100,000 a year is accumulating in a sort of a phantom loan. It's not due and payable during your lifetime on your ledger. So they're charging you interest and they're crediting you interest on this side. I have discovered that by using that arbitrage, most of my clients will usually average at least 2% higher payouts than what the average crediting rate is on the policy. If the policy has been averaging 8, but they pull out money the smart way, they're getting that arbitrage, and that means instead of a $1 million nest egg in that policy generating 8% payouts, okay, $80,000 a year, they can pull out $100,000 a year because they're earning interest higher than they're being charged, and so they pull out $100,000 a year. So let's say they do that for 20 years. $100,000 a year for 20 years. Now they have this $2 million phantom loan balance plus compounded interest, but they have way more money over here that's been growing. They have in their cash minus the loan is much more than had they been withdrawing it. But let's say they all of a sudden sold a property, they had a windfall, they inherited some money, and they go, I'm no longer insurable, Doug. What am I going to do with this $2 million? And I go, well, you can put it back in the policy. I can. Yeah, the IRS is calling it a loan repayment. The insurance company just says, oh, new money. And that $2 million goes in there, pays off this phantom loan that you didn't have to pay off. But now you hit the ground running with $2 million. You didn't have to wait 5 years and go through the TAMRA qualification. And that $2 million begins to earn tax-free interest instantly, because you're grandfathered to pay back loans even though you're not obligated ever to do it. Think about it. If you want to read and learn more, here's what I would like you to do. Go to laserfund.com, L-E-S-E-R fund.com, or click on the link below. And this is a 300-page book, actually 2 books in one. This side is 200 pages with all the charts and graphs and explanations. If you learn more by stories, you flip it over and you'll see how people use maximum funded IUL, which I call a laser fund, for all kinds of financial goals, especially for liquidity, and using this strategy, accessing their money for any purpose the smart way. So go to laserfund.com. There's options there to listen and learn, watch and learn, and even to attend webinars and classes. Check out Retire by Design. We teach those live and virtually, and you'll be blown away with the insights you gain.